Hi, in this video we'll talk about step 3 of the revenue recognition process, determining transaction price. So it's extremely easy, right? It's the price that the amount of money they gave to you. And the FASB refers to this as the amount of consideration the customer agrees to pay. Well, they say that word instead of saying money because in some cases the customers could give a non-cash asset, right? But it's almost always money. Now it's really easy unless we have a few difficult situations that we have to talk about in detail. One is variable consideration. That's where the amount that the firm is going to receive varies. So it depends on something. The other situation is the time value of money, when you're going to get paid maybe in installments, or maybe you get paid all at once, but later on. Got to consider the time value of money when recognizing your revenue. Non-cash consideration is another situation. And then consideration paid or payable to the customer. So the firm gives back to the customer, maybe with a rebate, perhaps free products or just a discount. So here's what we're going to do. Variable consideration, we're going to talk about in the next slide with an example. For the time value of money, pretty easy. The general rule here is like, if the time period for the payment is greater than a year, you should account for it using the time value of money. So if someone's going to pay you $10,000 4 years from now, you don't recognize $10,000 of revenue. You discount that back and then recognize the appropriate amount, which would be less. For non-cash consideration, generally speaking, you want to recognize revenue on the basis of the fair value of the goods you receive. And for the last one here, we're going to reduce the revenue by the amount of consideration that we give the customer, which is straightforward. How else would you do it, really? If you give a discount, you reduce the revenue by that discount. All right, let's talk about variable consideration. Okay, so Guo Construction Company enters into a contract to build a warehouse for a customer for $250,000. The contract also includes a $100,000 performance bonus that's going to be paid based on the timing of completion. So basically, they're going to get the whole bonus if they finish on time, but the bonus decreases by $10,000 for each week beyond the agreed upon completion date. It's pretty strong motivation right there. Guo estimates there's a 60% probability the project will be completed by the target date, a 20% likelihood that they're going to be done 1 week late, and another 20% chance they'll finish 2 weeks late. So how much revenue can Guo Construction Company recognize here? Well, we're going to use the expected value method, which is the most popular method for the situation. And here's our answer, essentially. 60% of the time, we're going to get the whole 350. Another 20% of the time, we're only going to get 340. Remember, our bonus will be reduced. And the last scenario, Guo thinks that 20% of the time, they'll be 2 weeks late. So you only get 330. Multiply them together, add them up, and the amount of revenue you're going to recognize is 344. The other approach is the most likely amount. And so then we would just say, hey, the most likely outcome is that we finish by the completion date. So we should recognize $350,000 of revenue. Most likely amount wouldn't be used in this case. You would usually use that method if you have something like maybe with 2 possible outcomes and one of the outcomes is much more likely. Like you have an 80% chance of getting a drug patent or something, and a 20% chance you don't get it. It'd have to be at least, I don't know, say 80% likelihood of one way for you to use the most likely amount method. When can you not recognize revenue with variable consideration? One is if the amount of consideration is highly contingent upon factors outside of the firm's influence. So in the last example, Guo had a lot of influence over when the project was finished. But what if you're talking about a contract that says that, you know, the amount we'll pay you depends on weather conditions, I mean, or the stock market? You can't predict these things. Another one to watch out for, guys, and also in your personal life, really watch out for this one. You know, contracts that where the amount paid depends on the judgment of third parties. So you may get a contract that says you make, you know, $70,000 a year with a $7,000 or a $10,000 performance bonus, subject to your manager's approval or subject to his, you know, or if you do an outstanding job or something. And it sounds great, but you start to think about it. You're like, well, who determines if I'm doing an outstanding job? And they can have a ridiculous opinion. They're allowed to. You know, a lot of people have ridiculous opinions. So you have no control over that. You know, you're not guaranteed anything there. So anyhow, FASB says no revenue to recognize if that's the case. Another thing is, like, if the uncertainty about the amount of consideration will not be resolved for a long time, then you're not able to recognize it. If the firm has limited experience with similar types of performance obligations. So last example, we had a construction company building a warehouse. Seems like they have experience with that, so that's why they could do it. But if you don't have much experience doing that, then they wouldn't have been able to use that. Or if the contract has too large a number or too broad a range of possible consideration amounts, you know, especially if the amount of consideration starts to get extremely variable. You know, you're going to be paid $1 million if it's done on this day, or you know, only $100,000 if it's done a week later. You know, it starts to get highly variable. The FASB says no, you can't recognize it. Let's look at consideration paid to a customer. Samsung offers its customers a 3% volume discount if they buy at least $2 million of its products during the year. So here we are, it is March 31st, 2016, and Samsung has made sales of $700,000 to Best Buy. In the past 2 years, Best Buy has bought over $3 million in the period between April 1st and December 31st. So what they're saying is that Best Buy is really, they're on track to surpass the $2 million mark. They're probably going to get a volume discount at the end of the year. The question is, how much revenue should Samsung recognize when it files its quarterly report on March 31st? Because at that point, Best Buy has not yet surpassed the $2 million mark. Well, again, we use accrual basis of accounting. We're going on our best information. We're going to assume they will surpass the mark, and we're going to go ahead and recognize just 97% of that 700,000, or 679. Okay. Now, when Best Buy, you know, at the end of the year, if they don't hit the 2 million mark with their purchases, they won't get a discount. At that point, we'll make an adjusting journal entry to fix it, if that's what happens. But for now, this is what we do. And I think this is a good stopping point.